One of my supporters, Darth Vega, asked me what the libertarian position on insider trading is. He asked it as part of the monthly AMA, but I thought it was important enough to warrant its own video. If you'd like to ask me anything, go to the links below to Patreon or Subscribestar and donate at the $3 level. So to begin with, let's define our terms. Basically, insider trading means buying or selling stocks or other securities based on information that's not available to the public. That could be perfectly legal. Only some forms of insider trading are illegal. The only form of insider trading that's made an offense by Congress is when someone who is in possession of the non-public material information sells or otherwise trades it to someone who isn't allowed to know that information. In other words, it's trading of the insider information itself. But that's generally not what we're talking about here. The SEC defines insider trading as the buying or selling of a security in breach of a fiduciary duty or other relationship of trust and confidence on the basis of material, non-public information about the security. In other words, you know the information, it's information you're allowed to have, and you buy or sell stock based on that. Where did the SEC get the idea that was illegal? They just made it up. It was not passed by Congress. You should be able to buy or sell your own stock based on whatever reason you want. For an example, I'm going to use the Martha Stewart case. In 2003, the SEC charged Stewart with securities fraud for selling 4,000 shares of stock in ImClone Systems in 2001. According to the SEC, she made the sale when she heard that CEO Sam Waksal sold all of his shares. Since the fact that Waksal sold his shares wasn't public information, the SEC said that counts as insider trading. They didn't even try to claim that she knew that, allegedly, Waksal sold his shares because he knew the FDA was about to fail its approval for the monoclonal antibody drug Erbitux. They just claimed that she knew he was selling. According to Stewart, she sold the shares because she had a stop-loss order with her broker. A stop-loss is when you give your broker a standing order to sell when the stock drops below a certain threshold, in this case, $60. The price drops below that, sell it. There are two kinds of stop-loss orders, formal and informal. Formal means go ahead and do it. Informal, which is what this was, means just call me and verify that's what I want to do. And that's exactly what happened. But a Secret Service director, Larry Stewart, no relation, testified to all sorts of stuff about how the note to her broker about selling shares when they dropped below $60 was written in different ink, and that means guilty somehow. Government pseudoscience aside, everyone basically backed up Stewart's story, including her broker's assistant, Douglas Faneuil. He backed her up completely until the SEC threatened to charge him with all sorts of felonies that would send him to jail for years, but they'd let him plead to a misdemeanor if he changed his story and testified against Stewart. How that isn't witness tampering, I'll never understand. So he gave this overdramatic testimony where he learns of Waksal dumping his stock and says, "Oh my God, get Martha on the phone!" That's a direct quote, people. The jury convicted her because the prosecutor convinced them that the whole idea of a stop-loss order is, quote, silly. He also made a big deal about how the stock didn't actually sell at $60, but actually at $58.43, and relied on the jury not knowing that this is typical of stock trades. By the time the trade actually goes through, the price has changed a bit one way or the other, and that's the actual price you buy or sell it at. Here's the real kicker. She wasn't found guilty of insider trading or securities fraud. Those charges were dismissed because there was no mens rea, guilty intent, to commit them. She was only found guilty of lying to investigators. She was guilty of lying to investigators by claiming she was innocent of something they never proved her to be guilty of. And the result? She had to spend several months in federal prison, all because she supposedly avoided losing $57,000 in stock value when Stewart herself was a multi-millionaire. Oh, and by the way, that Secret Service director I told you about, the one who supposedly examined the ink, he was charged with 2 counts of perjury. Apparently, he'd never even seen the note. So the question, as should always be the case with the law, is who was harmed? No victim, no crime. So who was Stewart's victim? People who say insider trading should be a crime say that it's the person she sold her stock to. Her selling her stock cost some other poor slob $50,000. Okay, who's the poor slob? Shouldn't he have a case against her, not the government? They all seem to think that she sold it to some people who then lost out, but that's not how the stock market works. You buy or sell stock from the exchange, not from the other people who buy or sell it. It's just like if you buy crypto from Coinbase. Who do you buy it from? Coinbase. Who had the crypto before they sold it to you? Coinbase. And who has your money now? Coinbase. Yes, other people are trading with Coinbase at the time, but you're not buying and selling directly with them. Same with a stock exchange. And even if you're going to say that she harmed people who bought the stock at the time, even if they didn't buy directly from her, they were going to buy anyway. So how were they harmed by buying stock they were going to buy anyway for the price they were going to buy it for anyway? No one can name someone she harmed or even point to someone she hypothetically harmed. This is the point where they usually fall back on, she harmed the market. The market is not a thing you can harm. It's an abstract concept used to describe the aggregate behavior of individuals. Speaking of the market this way is collectivist garbage. The market is made up of individuals. And so you're not going to harm the market unless you harm at least one of those individuals. They'll say insider trading harms the market by eroding confidence. But if anything erodes confidence in the markets, it's the realization that not all of the available knowledge is reflected in the price. That's what happens with all products. People want the price to reflect everyone's opinion as to the value of the good. But particularly with stocks, the price reflects not so much the current value of the company, but the expectations of future value. The absolute worst thing you could do is stop people with knowledge that may put that future into doubt from affecting the price accordingly. In the days before the FDA announcement, when people were dumping the stock, it caused a drop in the price. That was not the insiders destroying the value of the stock. That happened the moment the FDA decided not to approve Erbitux. The drop in price from insider trading was the reflection of the reality that the stock was now overpriced, and they were helping bring the price in alignment with reality. Oh, and by the way, selling the stock, as it turns out, was the wrong thing to do, at least long term. They got the $57,000 figure by cherry-picking the lowest part of the dip. If she'd happened to sell at that moment, that's how much less she would have sold it for. But the stock recovered its value relatively quickly, and then some. It was just a short-term drop. That $57,000 figure assumes that Stewart would have been acting with absolutely perfect timing. In fact, there's no reliable data showing that insiders have ever had any kind of unfair advantage in the stock market. If that were the case, then, taken in aggregate, the stock portfolios of corporate executives should perform better than the market as a whole, and they just don't. But years after this so-called insider trading happened, the stock did take a nosedive from the SEC action and the subsequent criminal trial. So why isn't that the problem, given that it ended up destroying almost $4.9 billion for Imclone shareholders? The reality is, unless you believe in conspiracy theories, you're forced to the conclusion that there is just no reason to believe that the information you get from insiders will reliably tell you the right times and amounts to buy or sell. But the laws against insider trading actually do cause real harm. Consider the following scenario. Alice's son needs an operation that costs $80,000. She sells stock in her company to get the money. As it happens, shortly after this, it's announced that an important contract her company was engaged in just fell through, and the stock tanked. Since Alice knew about this, they charge her with insider trading. Which means that, in reality, she's legally prohibited from selling the stock for any purpose, even something like medical expenses. This is almost exactly what happened with Ken Lay, except it was his own medical expenses he needed the money for. So those of you who are going to complain that this is purely hypothetical, there you are. Those two scenarios, Alice using the money for surgery and Alice committing insider trading, are exactly the same act with exactly the same consequences. So it's horrendous to say that she can't sell the stock for the operation, but it's equally horrendous to make one illegal and the other legal, given that they're exactly the same act. Let's put it another way. There are two actions here: receiving the information and selling the stock. Either one of those by itself is harmless, so why is it harmful when the two are brought together? Note that that's not the same with, say, a murder for hire. The basis for it is murder, which is illegal whether you do it for hire or not. Harms come out of actions. So, how can you make no harm plus no harm equal harm? To even go beyond that to basic principles, you have a right to have knowledge in your head. You have a right to buy and sell things. Why would it ever be illegal to do both at the same time? And another scenario, just to twist the knife in the absurdity of it all. Alice is planning to sell her stock. She gets good news about the company's future, and she expects the stock price to rise as a result. Because of that, she decides not to sell. Is she now guilty of insider non-trading? Should she be forced by law to sell her stock whenever she gets good news? What's the difference, people? Counterintuitively, insider trading gives an overall benefit to the market and the people who trade in it. The way prices work is through the wisdom of crowds, which is the aggregate value of all the action taken by people based on their various opinions, feelings, information, and anything else that affects what price level they're going to buy or sell something at. If a bunch of people have the idea that the price of a stock is going to drop, regardless of whether or not it's based on insider information, they're going to sell. That action itself is going to depress the price of the stock a bit, and if enough people believe it to the extent that it makes a noticeable drop, that sends a valuable signal to the market that trouble may be afoot. And even if they don't notice the signal and buy it anyway, they'd buy at a lower price than they would have, reducing their losses. And given what we've seen, that ultimately any price change due to the information is not long-term, it would usually end up making them money as the mean is regressed to. Anyone who bought the stock at a lower price after Stewart sold made even more money when the stock recovered. This is the value of the price mechanism. It takes a market, which is always going to have people with varying levels of knowledge in it, and the price mechanism is the most effective way of dispersing that knowledge, spreading out its effects so everyone can benefit. If you think it's unfair or unjust that some people have insider knowledge, the last thing you want to do is stop them from trading based on that knowledge, because that's the only way everyone else can benefit from it too. But as I said, overall, people with inside information about a company, like executives and CEOs, ultimately just don't benefit from it. In the long run, their portfolios don't do any better than the market average. Because the fact is, no one can predict the future. In 1970, if you were really fortunate, you had connections with the insiders at the biggest bank in Switzerland, which controlled the gold market. Everywhere gold was traded, it went through them, and they would assure you that they would never let the price of gold go above $40 an ounce. And if anyone would know, it would be them. You could not ask for more reliable information than what they were giving people at the time. The next year, Richard Nixon closed the gold window and ended the Bretton Woods system. The year after that, the price of gold went up to about $60 an ounce, and by 1980, it topped $800 an ounce. As I write this, the price of gold is over $1,600 an ounce. That really was insider information, and it was as genuine and reliable as insider information ever can be. And it was totally, completely, 100% wrong. I'm linking to an article from New Scientist. It's from back in 2005, but it makes the point well. It found that a model that assumes stock market traders have zero intelligence mimics the London Stock Exchange very closely. The results were published in the Proceedings of the National Academy of Sciences. But that shouldn't be a surprise to anyone who skeptically examined the stock market, like Richard Wiseman, who wanted to test how well an astrologer could predict the stock market compared to a financial analyst. For a control, he used a stock portfolio picked by a 5-year-old girl. The financial analyst's portfolio lost 46.2% over the next year, and the astrologer actually beat him, only losing 6.2%. The 5-year-old's portfolio made 5.8% during the same time frame. For another example, John Stossel was able to make a portfolio that beat the experts by pasting the Wall Street Journal on a wall and throwing darts at it. Over and over and over again, we see that, no matter how much ability or knowledge or skill someone has, they just can't seem to do any better than the market in the long run. There's no evidence that those who have inside information reliably benefit from it. So if you're a sensible person, you'll start calling insider information what it really is: rumors. No one knows what will happen to the price of a stock, short-term or long-term, based on some bit of information they have. And that will always be the case until someone invents a time machine. And all of this is really a distraction from the main point. Everything that goes on, every step of the way, is peaceful and voluntary. You can screech unfair all you want, but life is like that. Deal with it. Some people have advantages that others don't. Some people have information that others don't. Some people are smarter. Some are more talented. But none of that is really what matters. It's how you play those advantages and disadvantages that determines your success in life. And insider trading is a perfect example, given that, overall, those with inside information in their companies do no better with their stock portfolios than the market as a whole in the long run. Let's sum it up. Insider information is often unreliable. Even when it is reliable, it usually doesn't have an effect on the price of the stock. Even when it does, it often doesn't have the effect that one would predict. Even if it does, the effect it has on the price is usually in the very short term, and the stock rebounds relatively quickly. Even if it doesn't, it still doesn't affect the people who bought or sold the stock at that point, as they would have bought or sold the stock at around that price anyway, and the stock price would have done the same thing regardless of what the insider did. And even if it did, the effect would have been the insider sale lowering the buy price, or vice versa if the insider information is beneficial and the insider buys, thus being a benefit to them. Does anyone still wonder why I don't consider insider trading to be anything remotely resembling a crime?